Thank you for everyone coming here today. Thank the full founder-made team. We wanted to introduce a new word to everyone here. We'd like you to take out of your dictionary the word wellness and insert the word halo. I think everyone in here does not ever view themselves as generic. The word wellness was used in the 1950s by a doctor to try and get someone to live a slightly better lifestyle. Now we have moved on to HALO, which stands for Health, Active Lifestyle, Outdoors. Everyone in here is unique. Everyone in here is talking about big things, and I want everyone here to feel like they're part of the HALO effect. So today we're going to talk about the HALO movement. We're going to talk about what's bigger and what's going to happen and how some of our investors and entrepreneurs look at the industry. The one thing I wanted to bring up is I was in an Uber the other day, and I stopped at a convenience store. And I went in to get a iced tea, and I said to the driver, "Would you like something?" He said, "I'd like a Coke." And I said, you know, after all these years of education, there's this much amount of sugar in a Coke. So this guy's driving 12 hours a day, consuming 3 or 4 of these. So we have a lot of education to do in this industry, and once we do educate the consumer to join our lifestyle, things change dramatically. And when things do change dramatically, what's going to happen to health insurance when we're all healthy? What's going to happen to, you know, going to 5 or 6 fitness classes a week and how we're going to all feel and how happy we're going to be because all these endorphins are coming out and how much better we're going to feel because we went to a spin class and had a salad instead of had 5 drinks and a steak. So money's moving into this industry. More people want to be part of this industry. It's up to us to be inclusive and bring them in and welcome them with open arms and also make sure that entrepreneurs that deserve to get investment and have good ideas are able to get that money to build companies that then allow more of us to come into the industry so they can leave their banking and consulting jobs and do something fun with their lives. So I'm going to start off with Katie.
Oh, God.
No, sorry.
I'm out of order here.
That's it. Yes, I jumped in the middle. And you started Carbon 38.
Yes.
Clearly, there were some apparel companies that were around at the time.
Yes.
So can you talk to everyone here about how you kind of broke through and said, look, I'm going to create something unique and different, and there's space for that?
Well, so I started this November 2013, so we're coming upon our 3rd year anniversary, and I wanted to create something that was important to me. So I was a professional ballet dancer, a fitness instructor. I worked on Wall Street for a bit. I danced on Broadway for a bit. But I kept finding myself wearing spandex. And nothing out there really suited what I needed to wear every day. And then on top of it, there were all these little upstart brands, really cool activewear and active fashion companies that had no distribution. Either you go into, you know, an Equinox on consignment or a mom and pop Pilates studio, but there was really no place to distribute it. So we created a marketplace originally, and then started manufacturing our own product as well. And so while we were busy creating something, my co-founder Caroline and I were busy creating something that mattered to us, the whole activewear wave with Lululemon and, you know, Under Armour women and all that kind of rose up behind us, and suddenly we were in a hot market, which was great.
And you want to talk a little bit about some of the investors that you were able to get on board early and how they've helped you along the way?
Oh, God. Well, so we have 65 investors, and I thought we were a unique story, and then I met a couple pre-IPO companies that had very similar stories to me. We just took money from anyone and everyone because as a fitness instructor for 7 years, I really didn't have 2 pennies to rub together. I leveraged myself extensively and invested as much as I could of my own money through debt initially, and then we brought on some really cool people, like Amanda Freeman from SLT, and was, I think, our second check-in. The former president of Nasty Gal, Deb Benton, was maybe first or third check, I can't remember. One of the partners at Goldman who took Under Armour public was another investor. Brand president of Ralph Lauren, CFO of David Yurman. So I went out and I found people that I knew a hell of a lot more than I did, and got them to put some skin in the game and built out this kind of ridiculous network that's just kind of like a Frankenstein of investors that I put to work. And I am also creating value, but they're helping me create that value.
That's great. Congratulations. Craig, maybe talk a little bit about your show. And talk about how you also look at potential opportunities and early stage ventures at their inception.
Has anyone seen the show on CNBC? Adventure capitalists? There's got to be more than 3 hands from my friends. And they are my friends, trust me. So we're like Shark Tank for the outdoors. That's basically what we do. So we focus on the halo industry, active outdoor, wellness. We have a lot of fun. We travel. It's part adventure, part investment. Unlike the Shark Tank guys, we don't fight amongst each other. In fact, half of the show is basically us having a great time. And I was actually with NBC last week, and the executives, one of the points they wanted to tell me was that you guys actually look like you're too friendly on the show, which we are, because we're all kind of really close and good friends. And they want to, make it a little bit more edgy. They want us to fight, basically. They want me to be Kevin
Don't
Leary.
do it. Follow your path.
I'm trying to work out how I can be Kevin Leary, and with my other 2, co-investors. But we travel. So the concept of the show is we test products. We meet entrepreneurs. We do due diligence. We decide whether we're going to invest or not. It's all in the field. Unlike Shark Tank, we're not in a boardroom. We're not in suits. We're generally, barefoot on a beach in the Bahamas, in board shorts, testing the products. Whether we're testing, shark deterrent, devices in the Bahamas, or new tent systems in Yosemite, or hydration devices in the desert. So it's very cool. And literally, if they told me they weren't going to pay me for this, I would still do it, because it's just it's a great gig. So we just finished season 1. We just got picked up for season 2. So we're one of the 4% of companies, or 4% of shows that actually get picked up for a season 2, because we kind of resonate with CNBC from an investment side. Plus, we're a younger demographic. They're trying to sort of license off Shark Tank. So, based on what they told me last week, we're the highest ranking show in their focus groups for new shows. So it's a lot of fun. We are doing 2 things at the moment, which are kind of hard. Well, seeing I have a sort of a captive audience, we're recruiting a 4th investor, which we need to be a female. At the moment, it's basically 3 dudes, because we lost our female investor, Susie Mai. Some of you might know Susie Mai. She's awesome, from Mai Tai Global. But she couldn't continue, not for reasons of her doing. But so we're after a female investor who wants to be a regular on the show, who basically has a story, has success, loves action sports, outdoors, and understands the sort of investment environment, and can talk to entrepreneurs. I think that's super important. So we're reaching out to a whole bunch. I've seen a lot of people speak here today, listen to stories. I know there are people here who would do really well on the show. So if you're interested, track me down. Just type my name in anywhere you can find me. And secondly, we're actually recruiting for new products on the show. So, we're going to be doing about 13 episodes in the next season. It's a lot of companies, 50 plus companies we're looking to feature on the show. And I will tell you that about 70% of companies that came on the show, either through us or through external investments, actually raised money from the show. Big rounds, $1 million plus rounds. So it's just a ridiculously good platform in order to raise money from. Even if you're, just coming on for publicity. I mean, it's, you're going to get 13 reruns on CNBC just for turning up and traveling to Alaska or Belize or the Bahamas or Aspen, which are some of the places we're shooting next year. Anyway, that was a little bit too long. Sorry.
No problem. That's good. Jay, you want to talk a little bit about your, mental or actual checklist of what you look for in early stage companies and the entrepreneurs themselves?
I think for us, a lot of it is me finding entrepreneurs that I think I can help them actualize their vision. So if you look at the wellness agencies, we start to roll that out. That's about putting the talent first and helping them develop a sort of suite of monetization tools. But to your point earlier about the misinformation that's out there, or how much sugar is in a Coke, the budgets that those guys have are enormous. And we believe as we start to turn some of the talent into household names, we can start to change that conversation. But what we're also seeing is a lot of deal flow coming naturally out of these guys. A lot of these, I think there are real opportunities that are early stage there. To what we see in entrepreneurs, two things. I have a company called Band of Outsiders. It's a production company. We took a minority slug from ProSieben, which is a $10 billion, very forward-thinking European media company. They've probably made 80 digital and tech investments around the future of content in the last few years, and very healthy. Their stock's up 40x in the last 8 years. And we believe that constantly looking for content strategy opportunities, both for talent and some of the companies we work with, that we can really drive the asset value and the awareness of what we're trying to do. And to the entrepreneurial question, a lot of it, Robin Burzin, I think she's already taken off for SF, but from Parsley Health, who spoke earlier this morning, I remember sitting with her 3 years ago with her first version of her business plan, and she's like, I think with one other doctor, I can get to 1.8 million EBITDA in 3 years. And I remember looking at her going, can you scale it to 200 doctors? And you literally see her cock her head, and I think it'll take her 8 to 10 years. I think she's got $1 billion plus company in her. So it's passion, it's narrative, it's a unique twist, and more than anything, it's that perseverance to just keep going.
Great, thanks. John, you've been at North Castle. North Castle's been one of the early years, probably the longest standing health and active lifestyle and wellness fund on the private equity side. So every time someone comes to us and says they've got a new idea or they've got a company, they say, I've spoken to North Castle, I'm going to talk to North Castle, regardless of whether they have a PowerPoint or PDF or a real large company. So how do you guys look at opportunities, and how do you think about the milestones of telling an entrepreneur, look, go get some seed capital, come back to me in a couple of years, we're still friends, even though I don't want to do this deal now?
Well, now I have a whole new list of people to send them to. We do get a lot of calls like that, and it's they're fun conversations. I meet a lot of people that are very, very early on. It's just not what we focus on. We're sort of 10 million on up in terms of our size, and where North Castle will make our investments. But we try to help people understand the concept of a truly sustainable business model, and one where the economics make sense for the long term in terms of profitability and scalability. For more traditional consumer product and services businesses, there's lots of companies that could be built losing money for a very long time and get sold into the strategic world, or technology companies that raise a lot of money. That's not what we do. But I often tell people that are at the very early stages, Katie's story is perfect. It is like, go out and find really interesting individuals through your network that could be helpful, but you're probably in the personal investment phase of your life. And if your sort of next phase is venture capital. But that's a really good, the opening story there was a really good example, I think, at the very young stage.
Thank you, Katie, for that inspiring story to start. So Lee, you're at Topspin and also look at companies at their inflection point. So we'll kind of tell us how you think about when they hit that point when you're comfortable.
Yeah, well, I liked your lead-in for North Castle. Maybe you could do that for Topspin too. No, we do deals similar to North Castle, quite a bit in the health and wellness sector and in consumer sectors, a little bit smaller than North Castle. So we're actually coming across a lot of similar situations, people approaching us a little bit on the early side. We deal a lot with founders who have businesses, say, with $2 or $3 million of profit, and they come to us and they say, we want capital to grow, and we want to do it with private equity. And I think one of the most challenging things we deal with at Topspin is getting behind that and seeing if they really do want to deal with private equity. I shouldn't say deal with us. It depends on your perspective. But, and what I mean by that is, if you have a business that's doing $3 million of profit, you've got a pretty nice life if you own that business. You could just keep doing that and live a very happy, comfortable life. When a private equity fund comes in and gives you growth capital, everything gets reset because the fund has its own growth expectations and hopes for that business. And if you guys aren't aligned, if that person wants to continue the lifestyle that they had before or doesn't fully understand what it means to take on private equity, that kind of misunderstanding can lead to tremendous problems down the road. And so, in some sense, we're often pushing deals away, not because we don't like the company or we don't like the person, but rather because we can see that there's not that alignment there after having several conversations. That's the hardest part about gauging. I think it's something everyone needs to think about on the founder side too before you bring in money. Those investors are investing in you because they believe in you, but also because they want to make money and they want to do it over a certain time horizon. So that decision's a very important one, and it takes a lot of soul searching and talking with people who do it, including your potential investors.
Yeah, I think that's a great point. When we are on the advisory side, we typically ask someone first, what do you want your personal life to be? What are your personal objectives? Because the deal that you structure is going to dictate your personal life. It's going to dictate whether you're on a flight 5-6 days a week, whether you're going to go international, whether you're going to be on your cell phone 24/7 or not. So maybe back to KT, to decide, when you're looking at capital and people putting money behind you, how do you think about, maybe this is personal and you'll share it with us, but how do you think about what you're signing up for?
Look, my company is my life. As soon as I took that first dollar of investment from that individual, I knew that I was no longer my own boss. And yeah, that's scary. It'd be nice, to just run the business I have now, $20 million a year with like a nice little profit at the end. That's lovely. And I could do that for 15 years and it'd be great, but I'm too freaking competitive for that. I want to blow this up into something big, and whether that's $100 million or $1 billion business, it's quite honestly the same path, particularly for the next 3 years. So we are looking for growth capital. I understand what that means when you're signing up for that. I'm ready. It's going to probably be painful and suck a little bit, but I think that there's too much of an opportunity that I have in this company, and I've come so far on not a lot, that I know it's time to blow it out of the water. So, look, I don't know. Last night, it was Saturday night. I watched Naked and Afraid on Discovery Channel and wrote some emails. Like, that's sort of my life right now, and it felt wonderful, quite frankly. And I ate chocolate ice cream out of a Haagen-Dazs container, and it really was terrific. And that's where I am in my life right now. Now, I might meet the man of my dreams and pop out some babies, and it might be a different story. But hopefully, it'll be after this next round of funding, and then we can talk about that.
Pete, most of the companies in this sector sort of remain without investment, right? Because people have these lifestyles, and there are a lot of 20 million plus revenue companies that are being run by 2 and 3 person people that are having great lifestyles, and a lot of them should stay like that, right? And on the other side, most of those are not investable companies as well, because when you look at them and the opportunity for growth and scale and everything you want as an investor, and having investors absolutely sucks most of the time, right? Because they have no understanding about what you're going through as an entrepreneur. I mean, my 3 venture funds, we'd go in there every month, we'd have our board meetings, we pretend to know what's going on, act all holy, tell them a couple of things to do and why weren't they doing it. And every one of them, I swear, the moment we walk out, they'll go, they have no idea what we do every second of the day and how hard this business is, right? At the operating level. But if you want, like in Katie's case, you want to make a difference and you want to be disruptive and grow a big company, then it's kind of what you have to do. And everyone hates their investors at some point.
Right. Okay, well, that's not exactly what I wanted to part with. It's part of this event, so we'll keep going. But from a standpoint of actually, your lifestyle and the time that your business takes up and it becomes your life, John, maybe talk a little bit about clustering, if you're in the fitness studio business. I feel like, and Lee, you could touch on this as well, or first if you feel like it.
No, it's okay.
Thank you. So, I see a lot of people that start studios and say, okay, I'm going to put one in LA, I'm going to put one in New York, I'm going to put one in Miami, one in Boston, and they figure out, okay, wow, I actually have to go to all those 5 places, or have these 5 people where I could have 5 studios in New York City and taking the subway or taking a taxi around. So I just want to get your perspective, with your investment in Barry's and others, of how you think about that and your management team actually physically being in one place.
Yeah. The whole proof of concept, if you have a four-wall business, and when you're ready to expand outside your core market is a really important question you have to ask yourself. And probably one of the most important parts is how will the studio do if it's going from 1 to 2 or even 3 in one market to your first one in LA when I'm not here for 2 to 4 weeks at a time? Because that's often what it takes until you're at double-digit numbers of locations. How consistent are your results? How do classes fill when you're not teaching them or your number one master instructor is not teaching them? And so there's lots of variables in deciding when to leave market. But not all markets are the same. And a lot of people have great brand in their local market built from 7, 8, or 10 years ago when that industry, in this case boutique fitness we're talking about, might have been really young and establishing a brand was a little bit easier. And today you might move into a market and you're going to be the 12th of your concept. And if you don't have national brand recognition, you have to have a real plan as to how to create that. And we're about to start that with Barry's. I mean, we're really, really well established on the West Coast and the East Coast, and we're going to start opening up new markets. And for the first time ever, we'll open in a few weeks in Chicago, where we won't be the first brand of our kind, in that market. I think we're fortunate to go in with a fairly strong brand and a lot of PR behind us. Just quickly back to the earlier question. I mean, so a lot of people ask about the Barry's story, and Barry's was exactly that business that the original founders didn't want to expand. They had a few locations here in Southern California, and they were very happy. And only after a new person came in and really started to run the business and open up a new market was it time for outside capital to come into a business like that.
Great. Lee, you want to talk a little bit about some of your assets and clusters?
Yeah, sure. I think great answer, John. I'm happy I let you go first. Just to add to it, the studio model, which I think everyone probably in this room, it sounds like they're a believer in, is very powerful. But at the same time, it's all about the person running the studio at the beginning. That's the essence of what creates the community, has people coming back because they're energized by that person. I mean, there's probably 15,000 CrossFit boxes around the world. Most of them are not good businesses, and it's because the person running it is not good at creating the community. CrossFit itself is a wonderful business, but I'm talking about the actual boxes. So when you decide you're going to take your studio and make a second one or a third one or go into a different city, and you're not going to be there, you have to have the process in place. You don't want the customers to feel like there's a process, but there has to be basically a formula for how you create that community in your new locations. If you don't have that, then you're just opening locations and slapping a name on the door and hoping your manager out there has energy. And that's just a risky proposition. So I think it's very much about creating that formula. I hate the word formula, but it's got to be there. To have a chain across the country. And I'm sure Barry's is doing a great job of that because the programming, the name, the look and feel, all that stuff has to be right, has to fit the brand, and has to fit what has people coming back over and over again.
Great, thank you. One of the things I want to move to is when someone's raising growth capital, it's typically for an expansion of their corporate overhead. And obviously this is a people business, and those 10 hires that you're going to make at corporate is probably going to make or break whether you have a good company and what your culture is. So, Jay, you want to talk a little bit about, as you see companies and say, okay, here's on an org chart what we need, here's kind of the types of people we need, what their skill set is, and what their fit is with the entrepreneur or the CEO?
It depends what stage the company is, and we'll use very high-end outside headhunting firms at times to really good effect. And a lot of times it's, I guess I come back to some of that early stuff. It's identifying who's right for the job for the next 2 years. It's not about 5 years down the road. It's about getting through the next couple of roadblocks with the right momentum. And you hire the wrong person at the right time, the right person at the wrong time, doesn't do you any good.
Great, thanks. And Katie, from a standpoint of taking additional investors in, have you had any conversations with, well, I'm putting this money in and I've got this great person that I'd like you to bring on, or have any of your new hires been screened by your current investors, or how's that worked?
So I actually have just kind of finished hiring our C-suite in preparation for the 2017-2018 larger institutional round. And I did that a little bit on purpose because I didn't want, I wanted to build the team I knew was right for my company and not listen to, sorry guys, not listen to somebody else's opinion on that, because I feel like I know my customer the best right now, and I'm sure, you know, all these guys have seen pattern after pattern after pattern, and I totally respect that, but I do think I'm starting a new pattern, and maybe that's just, you know, my whatever ego talking, but it's there, so we have to do what we have to do. So I focused on hiring the best talent, and as a CEO, like, my 3 main goals are to raise money, hire, and maintain vision. And so, you know, I brought in you know, to date around 11 million. So I've done my fundraising job now until we, you know, get to break even. It'll be great. And then the next piece was to just build out that team. And so I've spent the last 18 months just like, you know, romancing anyone I could find. I really went after like where my weaknesses were. That sounded terrible, didn't it? But I went after where my weaknesses were and really targeted people that I knew would be the perfect fit for a company at 100 million. Because I feel like that's in the next 2-3 years we'll get there, and so I wanted to hire to where we'll be in the next 2-3 years, and I convinced them that, you know, me standing in front of you at, you know, 1.5 million a month, like, please come work, and sure enough they did. It took a lot of work, but that's something I'm very proud of, and that's something that has been my #1 focus.
That's great.
The other thing I would say there, and I do think they're linked, is the funding side with the executive development side. For the companies we work with, a lot of times it may be strategics, it may be funds, it may be high net worths, and I want people who are like, oh, you know, it should feel organic, it should feel natural that, yeah, they want to put in money, and they've just introduced you to this amazing person who's going to do 5 other things. That's smart money. Like, dumb money kills your company. Smart money adds so much more value than the capital, and I think you should be sussing that out, feeling that out all along the way. You want that money to feel like a real value add beyond the capital.
Can I say one thing? I mean, the best partner you can have from a funding perspective is a strategic partner. You know, if you're just going in, if you're just taking money, particularly as an entrepreneur, from the point of view of just getting capital, then that's just, you know, not sustainable. I think, you know, the #1 thing you should focus on as an entrepreneur is, you know, who's the best strategic partner first and foremost. The amount of people that have come through sort of my doors and all they want to talk about is money, you know, just like completely turns me off. But the guy or girl who comes in and just talks about, we'd love to have you on board for this reason, for this reason, for this reason, they lay out the strategic plan around how you can help them, that's the partner that you want to have. And if they influence your hiring decisions, then that's a great thing. A lot of the times.
So let me just expand on that. So when you do put money into a company on an angel round basis and the money's hit the bank, what do you expect from an entrepreneur? Do you expect monthly structured updates, quarterly updates, give me a call when you need me? Because obviously there's not really a formula for that.
Depends how much money I'm putting in.
Okay, that's a great answer. So
if it's a lot, then it's a heavier lift, right? Well, it depends. I'm pretty sort of light, but, you know, obviously there from a strategic perspective because, you know, I'm spread relatively thin. But, you know, I don't expect reports. I expect communication. I expect to be told when, you know, shit's hitting the fan and how I can help. But generally, you know, there's no sort of formal structure around that from a reporting basis. That's kind of how I work.
All right, Lee, from a standpoint of entrepreneurs that you partner with and what kind of ownership you expect them to have or option plans? You want to give a little visibility into how you think about that?
Sure. Well, it depends if the founder is going to stay on board. Generally speaking, if they don't stay on board, we don't necessarily need. A lot of people have a philosophy: if you believe in your business, you should stay. Keep some equity in the business, even if you're not going to run it. We don't mandate that. It really depends on what we expect and what we hope from them in the future. If a founder is staying on, we like them to keep a meaningful stake. The best thing we can get out of the structuring of a deal is a good alignment between our equity and the equity of the person running the company. Now, if it's not a founder, you create incentive equity plans to do that, but it's not perfect. Option plans and the like tend to be basically very low risk on the downside and a lot of rewards on the upside. Our equity, we lose our money if the company goes under, and we make a lot of money if it does well. So the ideal situation is one where the founder stays in, has a substantial stake, the equity is side by side with yours, everyone does great if the company does great, and everyone doesn't do great if it does not. And that's typically what we try to emphasize. We try to create structures that have as much alignment as possible.
Yeah, just in closing here, I wanted to have each one of the panelists just give some words of wisdom or maybe a takeaway that you've had. One of the private equity managing partners I worked for several years, we were trying to buy a company and then potentially trying to sell it as quickly as we could because we were trying to catch a trend. And he said to me, Pete, build something of value, and at the right time when you want to sell it, someone will buy it from you and they will pay you appropriately for that business. So in this industry, I think there are a lot of trends and there are a lot of fads, but if you build a real business that has good unit economics and makes money, you will be the decider of when you sell it, not someone else. So pass that along.
I would keep your eye on your business model, and it is more than okay. It's expected that it will evolve and you will adjust it, whether that be the exact consumer you're targeting, your price point. I mean, there's obviously a million components. The channels you're distributing to, if you're a product company, but I believe people should typically pay attention to the profit stream ahead, and not when we get to 200 million, there'll be enough gross margin points to cover the infrastructure. In the product space, again, and I think that's what most people are here, or services. This is not very different probably in media and technology and lots of other industries. But I believe sort of keep your eye on that ball. Losses are perfectly more than fine. They're expected for young businesses and need to put capital in. But that's when I talk to entrepreneurs who have sort of crossed that threshold, I hear over and over again that sort of evolving and keeping your eye on that ball is pretty important.
I think you've got to be in the business because you're passionate about it, and stay in it because you're passionate about it. I think this industry, because it's gotten so big, anyone who's been to the Expo West conference over the last 10 years has seen that has expanded from literally 1 hall to 10 halls and 70,000 people. And most of those people should not be in the business. When you walk those aisles and you just go, what the hell are you doing in this business? Because it's a big business, right? And the business of health is business. And I think the fact that passionate founders still exist is awesome, but I think it's hard to find them. I think the industry's been poisoned by a lot of superficiality and industry around it. So for me, I'm looking for passionate investors, honest investors, companies that I think I would run if needed to be the case. And I'm also looking for companies, when I meet entrepreneurs that I mean, a lot of times I've said to myself, why the hell didn't I think of that? Those are companies that I want to invest in. So, innovative, disruptive companies that I just like, why didn't I think of that? So I don't know, not really words of wisdom, but
No, it's great.
a couple of comments.
This past week, I just saw Stephen Rails, who's the founder of Danaher, speak. And if you don't know who he is, I would Wikipedia him right now because he's totally baller. He's built, since 1969, he's built something that's worth close to $100 billion with his brother. So just Wikipedia him. And his words of advice were long-term. And I think that I, especially kind of stuck in this upstart kind of sub-$100 million world, we're so used to, being pushing for that top line and buying top line and worried about, the competition and how are we going to grow so that we're bigger than the competition and all this stuff. And watching him speak, you realize that if you build a solid business with really terrific margins that is on the path to profitability or profitable right out of the gates, you'll have something that will have a lot more longevity than, just a flash in the pan. And I had that aha moment this week, so I'm sharing it with you now.
Again, Katie.
Because I was so hell-bent on getting us to 100 million and selling, and when I heard that, I thought, you know what, maybe that will happen, but I want to build something that is important, that I have customers who are passionate about this, and I owe it to them to create something that's meaningful and long-term.
Thank you.
I think it's this idea of holding these two concepts sort of separately, and one is you have to have a team that can call bullshit on you whenever you need to hear it. And it's a formal, constructive feedback loop or an informal. It's friends, it's advisors, it's board members that you truly trust. But then at the same time, you've got to have that vision because that company is your dream and you're the only one who's going to make it happen at the end of the day. And it goes back to your point about passion and perseverance and persistence. But you have to have a real group of people that you trust their input and that they can tell you what you need to hear when you need to hear it.
Katie said something earlier that I think is a great message, which is she said when she was referring to her investor, she said, I know my customer. I know my customer, and I'm going to trust my gut. I think you want to take, since this is about investment, you certainly want to take on value-added investors who can add their networks, add their knowledge and their strategic guidance, be a sounding board. But ultimately, you're on the front lines of your business. And in choosing your investor, it's very important to choose one that not only believes in what you're doing, but defers to you as someone who's on the front lines day to day, interacting with customers, interacting with vendors. If you choose one who thinks they know it all and can change your business entirely overnight, they may be able to, they may not, but you won't be a happy camper. So trust your gut, trust your vision for your business, and pick investors who are aligned with that and will defer to you when the time comes.
And I will say that once you get the investment, then the hard work starts. I see some entrepreneurs say, I just raised like $5 million and they want to take a vacation as if their work is done. Now they have to actually go and deploy it properly. So I want to thank everyone on the panel here. I want to welcome everyone officially to the Halo sector. Thank you. You are now a Halo enthusiast. I will give you a wand and I will make you a Halo enthusiast later.
Trademark.
And if you have any questions for us afterwards, we're all available. And keep up the great work and keep making things happen. Thank you.